So I'd like to introduce our speaker for today, Paul Willen. Paul Willen is a senior economist and policy advisor in the Federal Reserve Bank of Boston Research Department. His research focuses on household financial management. He recently has spent much of his time studying mortgage markets. His research appears in the Review of Economics and Statistics, Economic Theory, the Journal of Finance, the Journal of Public Economics, the Journal of Urban Economics, the NBER Macro Annual, the Brookings Papers on Economic Activity, and elsewhere. Willen's research on the origins of the subprime mortgage crisis has appeared in scholarly journals and has been cited in virtually every major newspaper in the United States. Prior to joining the Boston Fed in 2004, Willen was on the faculty at Princeton University and the University of Chicago. He is a visiting lecturer at Harvard University and has been a visiting member of the faculty at the Massachusetts Institute of Technology. Willen did his undergraduate work at Williams College and earned his PhD from Yale. Oh, that makes two of us. All right, welcome, Dr. Willen.
Yes, and I'm not mic'd, so I should, for this.
Just speak into that, you'll be fine.
Okay, perfect. Okay, good morning. Thank you. So this is my first presentation, but I've taught, but my first public presentation since March 5th of 2020. So I hope you'll bear with me. Okay, so let me start with it before I say anything else, the disclaimer. So I'm speaking to you today as a researcher and as a concerned citizen, and not as a representative of the Boston Fed or of the Federal Reserve System. So you recognize, it's interesting because for years, the Fed chairs were always very, Ben Bernanke was unmistakable, and Janet Yellen was unmistakable, but Jay Powell just looks like, a guy. He's like a, kind of a white guy. But anyway, he is, when I say we, I don't mean Jay and me, and that's important. I'm not speaking, this is not an official, don't say the Fed says, say some guy from the Fed told you. Okay, so what I'm going to talk about today really is the current situation in the housing market. So is about to try and understand where we are and where things are going. And so this picture here is not surprising to any of you. This is national data, but it's been similar, as I'll show you, pretty much everywhere in the country, that we've had extraordinary period of house price growth. And so you can see there on the right, that's where we are, have been over the last 2 years. And what's mind-boggling is when you compare that to what we previously thought was a period of extraordinary house price growth, which was in the period 2005, 2006, 2004, 2005, 2006. And so to have, the last few years, well, I'd say the last 15 years, starting with the financial crisis, is a history of things happening that you never thought could happen. In fact, I teach a macroeconomics class. And so we used to teach people that there were all kinds of instruments of the money market that the Fed had, which nobody would ever use. And then while I was teaching the class, we started using them. And so I would have said, we will never see house price growth like what we saw in 2005 or 2006 again, and yet here we are. And so it has been an extraordinary period. It is we have also seen, as you all personally know, an unusually large number of home sales, but the increase in home sales is small relative to what happened in the 2000s. And when you remember that the housing stock is considerably bigger now than it was 15 years ago, it does tell you that the period in the 2000s, even given what's happened now, was an extraordinary a time. Okay, so the question, I'm going to discuss this question, is there a crisis in the housing market? And so I'm going to answer, I'm not going to answer. I'm going to ask. Max said to me that we would have some time for Q&A. And I said, I don't have a lot of A. I have mostly Q. But anyway, so I'm going to ask these questions. Why are prices going up so much? Another question is, do we have enough housing? And then the last question is, have recent increases in mortgage rates, are those making a difference in the housing market? And I'll try and do all of that in, I don't know, I guess I have another 15 minutes. Let's see. Okay, so I'm going to give you a little, since I do some teaching, I have to do a little teaching here. And so before I go on, just to frame our discussion here, is I think this is something that is certainly to realtors would be very familiar, which is that housing is two things. When people buy houses, they're buying something to consume, and they're also buying an investment. And so one kind of metaphor we use for this is that when you drink milk, you can buy milk or you can buy a cow. And milk is a flow of services. It's the flow of milk that you're drinking right now. And that's like renting, but that's the consumption value of owning a home. When you buy a home, you're not just buying the home now, you're buying the perpetual right to live in that home, to consume that home forever. Even if you only want to live in it for a few years, you still have to buy it forever. And so you're buying a long-lived asset, which is an investment. And the decision to rent versus a decision to own is muddy, because even when you own, what you're really trying to get out of it, or some people are, is the flow of services from the house. And then what you're comparing is not the cost of buying the whole house and buying this perpetual claim, but you're just what we call, considering what we call in economics, the user cost, which is the cost of owning that house for some period of time, for a year, say, which includes interest, it includes depreciation, and importantly, it includes the change in the value of the property over time. And so when we think about housing and when we think about what's going on right now, it's important for us to distinguish between the price of consumption of housing, which is the price of the flow. It's either the rent or what we call the user cost, the cost of owning the house for some period of time. And then we have to think about the investment demand, which is the demand for an asset that lives a perpetual claim, the perpetual right to live in that house. Okay, so why is this relevant right now? So the headline number that you see is prices. And so what does this figure show? This figure shows house prices going back to price growth, going back to 2015. And you can see that before the pandemic, it was gently rising, but it was in the 4 to 5% range, which is, reasonable house price appreciation. It was nothing crazy. Over time, that adds up. It's compound interest, but it was not. It was not extraordinary house price growth. Then, early in the pandemic, we had house price growth slowed a little, and then it sort of took off in the second half of 2020 and has been at a very high level since then. So where is this coming from? So the driver here of price growth has been rent growth. And what you see here is that in this period, so initially there was some price growth that preceded the rent growth, but for most of this period, the growth in prices has been more or less very closely matched by an increase in nominal rents. So these are all in today's dollars. So where is this increase in rents coming from that's driving the increase in prices? And the answer is about half of it is coming from real increases in rent, which is to say real increases in the demand for housing. And about half of it is coming from inflation. So where is this price growth that we're seeing coming from right now? A lot of it just mirrors inflation. And the real rent growth that we're seeing, that's the part of this that we might be concerned about in terms of thinking about the stock of housing and about whether we have enough housing. But that's the portion of it. The increase in real rent is the increase in the flow demand for housing. It's the increase in how much people need housing as a consumption good. There's inflation, and then at the top there is we focus on, it's the price to rent ratio. And there has been an increase in the price to rent ratio, but it's been actually surprisingly small. And why is this significant is if we compare this with the last boom, with the last decade, and this is using different data, but it's the same basic point here. In the boom, all of the boom in 2005, all the price increase, all the change was in prices, and none of it was coming from rents. The rents were basically staying the same, maybe even going down a little. All the increase in prices was coming from prices relative to rents. And so the way you can interpret this, going back to my previous slide, is in the 2000s, basically there was an increase in demand for housing as an investment. Whereas now there's an increase in demand for housing as a consumption good. And that's what's changed. And that's why the situation now is so profoundly different from what we had in the 2000s. Okay, so and so the question is, where is this increase in consumption demand coming from? And one of the popular stories about this is that it's coming from the fact that that it's easy. People no longer need to live in places like Boston. They can live anywhere because we discovered something that many of us knew already, which is that you don't really need to go to work. In fact, I don't know about you, but for years I was a kind of I was a early adopter of work from home, so actually, when I brief digression, when I started at the Boston Fed, this was in 2004, I asked the guy who the head of the research department at the time. I said, "What are other places I've been interviewing with had very strict policies about work from home? You had to sign an agreement, you work on only on 1 day a week, and a very rigorous set of rules." And so I said to Jeff Fuhrer, I said, "What is your policy?" And he said, "If you want to work from home, just send me an email in the morning." And so I took him literally. Anyway, and so, but I still live in one of the most expensive places I live in Brookline, which is ridiculously expensive. So anyway, we could discuss that later. Anyway, okay, so, so the question is this driven by changes is it driven by this work from home in the sense that people can live in different places? All kinds of places around the country have seen increases in prices. Places like New Hampshire, which previously were not places where someone could have the sort of high-paying job that you might have in Boston. And so the problem with this is, if that were what was happening right now, we would see huge relative changes in prices, but no absolute changes in prices. Prices would be going up in New Hampshire and down in Boston. But that's not what we're seeing. So this figure, I usually very carefully annotate which line is which in figures. But I didn't in this case, basically to highlight the point that house prices went up rapidly everywhere. So those lines, there are some differences there, but they're very, very small. Most of these increases happened everywhere. And I actually pulled, this is data that's the US as a whole. That's Massachusetts. So Massachusetts has grown a little less than the US, but New Hampshire has grown a little more. So there's no question here that there is some substitution between New Hampshire and Massachusetts, but that's on the margin. The main story is that prices have been going up everywhere. And so the question is, why have house prices been going up everywhere in the country? And that's the question about whether we have too many, whether we have enough. We don't have too many. We definitely don't have too many. The question is whether we have enough. So a lot of people have said that the problem is, the reason house prices are going up so much is because we don't have enough houses, because we're not building enough housing. And so they point to the 80s and 90s and they say, well, that's where we should be. But this over here, that's where we are. And our analysis of this is that and I'll explain why, is that we would expect, based on the fundamentals, to have a lot lower levels of investment. So our forecast is that investment, the number of new homes that we're building, is about where it should be, and that it's going to go down. And the reason is that in the long run, the main driver of housing stock is population growth. The number of houses we need is roughly proportional to the population. And there's a huge issue, I'm aware, of household formation. But in the long run, we're going to see, household formation will go up a little. Household size has been coming down, even if you take that into account. Population growth has slowed. So this is population growth over here. This is census projections of population growth. So going out to 2050. And you can see population growth was very high in the 70s. And then it slowed, and it's been slowing more. And actually, unlike economic forecasting, population growth forecasting is actually, they're actually very good at it, unlike economists. and the reason is because it's not complicated. Basically, there are births and deaths, and so what's happening right now is that the birth rate is going down, and that's not because, as you might imagine, because people want fewer kids. What's happening is that the distribution of the age distribution of the population is changing, and since the age distribution is getting older, there are more people who are at the part of the age distribution when they don't have children. And so that's why the birth rate is going down. And again, the death rate isn't going up because conditional on being alive, you're more likely to die. It's just that the fraction of the population that is old is going up. But the upshot of that is that natural population growth has been falling. And the issue here is immigration is going to offset that. And then you have to make some forecast about immigration, about what you think is going to happen to immigration. But basically, the pattern we're seeing here is population growth is low and it's getting lower. And those are reasons why we would not expect to see, we don't need to build the number of houses that we needed to back in the 70s and 80s and 90s. We're just never going to need to build that many houses again. And so we did have, during the last boom, we had a spike in the number. There was a lot of construction. And so we actually had, you might argue, too many houses. So this is the number of houses per household. It went way up. And a lot of what happened in the last decade was we had unusually low construction. A lot of that was just to get back to kind of historical levels of the number of houses per household. So it all depends right now on what you forecast for what you think is the normal, what you think is the right level. But I don't think there's any sense right now that the number of houses in the country is, that we don't have enough houses. Every piece of data we have, to me, suggests that we have roughly historically normal levels of housing, and that the amount of construction we're doing is consistent with changes in population. It leaves us, you say, well, then why are house prices going up so much right now? And the answer is the COVID effect has not been that it's changed where people want to live. It has had some effect on that. I'll show you in the next slide. The main thing it's done is it's made housing more important in people's budget. And so basically the amount of the budget that the typical person is willing to spend on housing has gone way up because they're spending a lot more time in their homes. And that is what's driving the price increases. And so if that happens, we could see everybody living in exactly the same house, but you'd see much higher rents and much higher prices, simply because people are willing to put a bigger share of their budget into housing. And so I don't think that it's not that we don't have enough homes, it's that people value housing much more than they did 3 years ago. And that does have to do with the work from home. Even if you live in Brookline, you're still spending a lot more time. It's hard to imagine how I could spend any more time at home. Okay, so this is just to say about population growth in the region. This is population growth in Massachusetts. And what's interesting here is that after the financial crisis, population in Massachusetts grew at about the same rate as the country as a whole. And that's pretty shocking when you think of how expensive Massachusetts is, how difficult it is to add people in Massachusetts. That's surprising. In the pandemic, the population we've seen a shift. New Hampshire has kind of the opposite pattern, which is New Hampshire was growing at the same rate as the country before the financial crisis, then slowed, and now this is all consistent, I'm sure, with your own anecdotal evidence. You can see we're seeing a relative shift of population from Massachusetts to New Hampshire. So I'm not saying that's not going on. I'm not saying that's not playing a role, but the first order issue here is that everybody, everywhere, is valuing, the simple way to think about it is just that they're willing to spend the bigger share of their budget on housing. Okay, so the last thing I'm going to talk about is very short term, which is what's happened in the, what's happening right now. And so you're all very familiar, I'm sure, with this increase in interest rates. So this is the Freddie Mac 30-year primary mortgage market survey, fixed rate. And they actually have this series, it goes all the way back to 1971. The increase in rates from basically the end of, from the beginning of the year to the end of the first quarter, is the biggest increase in mortgage rates over a 3-month period since they started doing the survey in 1971. What's all the more remarkable, there are other competitors, there are other 3-month periods where it's close, but they're all in the early 1980s. There, rates are going from 10% to 12%. Here, they're going from 3% to 5%. So in percentage terms, we've never seen anything like this before. This huge increase in monthly payments. So what have people been doing? So we have data from a company called Optimal Blue. These are mortgage locks, and it's nice that I'm in an audience where I don't need to explain what that is. So these are mortgage locks. So this data goes through we get these every week. We actually have daily data. We have, we actually have they're all anonymized, but we can see, the zip code and the amount and everything about the loan, monthly payment, the interest rate, everything we need to see. And so what you can see is that what surprised us was that these increases in interest rates, households were basically just eating them. So rates were going up, and you might think people would start substituting into cheaper homes, but they weren't. They were buying the same homes, and so I'll show you in the next slide. In fact, the amount that they were spending continued to rise. Basically, in our data, at least until last week. And so you can see here, people were basically willing to spend. They weren't changing their behavior at all. They were, as far as we could tell, buying the same homes at the same price that they would have bought them back in the fall, when rates were, 3.5%. And it really only happened last week that we began to see people reducing their spending. And let me show you here. So I think we did with these slides, they're a little they were in Acrobat. I think they were converted to PowerPoint. Is that why this? So that should say average purchase amount. And you can see basically there's a big drop in the average purchase amount. And we've seen, fluctuations before, but really we haven't seen anything like this since, March of 2020. So people are definitely cutting back. I think the question is whether this is really a turning point. In our data, at least, we also saw some reduction in the number of applications. Or this is not applications, it's locks. But it's a little hard to interpret. But it certainly seems, and there are other data points that are consistent with this, that we're beginning to see a turning point, that people aren't willing to just mindlessly pay whatever the market asks, and that we may be beginning to see a slowdown in the housing market. All right, so I'm going to conclude by just one last, just a little bit of economics, to say why, initially, when I first saw this, I wasn't this here, the monthly payment, I wasn't completely surprised. And let me try and explain why. So this mortgage rates are tied to, their interest rates. And normally we benchmark them using treasury bonds. And so, their substitutes mortgages are for treasury bonds. And I'm just going to use the 5-year, this is a 5-year yield on a yield on a 5-year treasury bond, which is right as a bond with a, which has a duration of 5 years. You get interest for 5 years and then the principal's paid back. And you can see we had a big increase around the same time as mortgages, not surprisingly, since they're substitutes. We saw a big increase in the 5-year treasury. So arguably, it's in the treasuries where it started, and then it spread to the mortgage market. So we saw a big increase. The increase in mortgages was bigger. That's something for a separate discussion. But most of the increase came from interest rates. Okay, so that's the nominal. That's what we see. Okay, the important thing for a borrower, for a rational borrower, however, is not the nominal interest rate. What matters is the interest rate taking into account future inflation. And that is what we call the real interest rate. And so the real interest rate is because when you borrow the money, if inflation is high, you're borrowing money in today's dollars and you're paying it back in much less valuable future dollars. And so this red line here is the real 5-year interest rate, which we get from these inflation protected securities. So you can use that to back out what the real interest rate is. And what's happened, as you all know, is that inflation expectations have gone up. And so this is expected inflation over the next 5 years. So in a sense, you can think of it as an average inflation for the next 5 years. And it's gone from being in the 1.5 to 2 range up to 3%. So what does that mean? It means that even though the nominal interest rate has gone up, the real interest rate is still extremely low. And it's true, it's not as low as it was last year, but it's lower than it was, at any time. It's as low as it's been at any time, in the last, whatever it is, 8 or 9 years. And it's considerably lower than it was, any time before the global financial crisis. And so it's a little hard right now to know how to interpret. So interest rates seem high, and you might be kind of thinking, well, with interest rates as high as they are now, maybe it's a bad time to buy a house. It's still, by historic standards, an extremely good time to buy. The interest rate in real terms is still extremely low. And that's why there was some question as to whether people's decisions to continue spending a lot on houses, whether some of those decisions, initially, as I said, when I saw this picture here, I was surprised. And then you're saying, well, maybe what they're doing is they're thinking, well, it's true, I'm spending a lot on a house and the monthly payments are big now. But if I believe inflation is high, those monthly payments are going to go down over time. And in real terms, it's still a good decision. So how this plays out, how inflation evolves over time, obviously that's going to play a big role in what happens to prices relative to rent. So this is a decision when you're thinking about this as an investment. You're paying attention to this real interest rate here, and as an investment, paying a lot for a house may still be a reasonably a sensible decision. Okay, so I'm going to stop now and take questions. I think I probably took longer one always does.
Thank you, Paul. Let me just get the microphone here. So thank you, Paul, for your remarks. I think they challenge conventional assumptions here. So there's gonna be some good questions. We have some handheld mics going around the audience for people who would like to ask a question. Also, those of you online, if you have a comment or question, you're invited to enter it into the Q&A function at the bottom of your Zoom screen. And then Jason will maybe read those and screen them, and we'll read them off for Paul. So questions or comments from the audience, handheld mic, starting over here on our right.
Hi, Phil Lamro. So I'll be your first volunteer. I noticed on your graph of population growth, there's still kind of a bump, and I think that we all kind of are aware that the baby boom is kind of approaching peak earning, or maybe just past peak earning. Do you think much of the increase in demand for housing is driven by a desire for second homes of that baby boom group that may subside in 20 to 30 years out?
That's a very hard, like most of these questions, I think it's kind of an extremely difficult question to answer. I mean, right now, I think there's obviously been a huge increase in demand for second home. My sister bought a house in Western Massachusetts. And what I would be more concerned about is second home ownership is a lot of work. And I think people are naive. And it sort of sounded like a good idea during the pandemic. And what I would be worried about, and then there was this crazy thing, whether, a few years down the line, driving 3 hours and taking care of some house in Western Massachusetts will seem like as good an idea as it does right now. So I would be very concerned. And, we spent a lot of time in Vermont, and, Vermont is still scarred by the second home boom of the early 80s. There's still, condos. There's still condo developments that people lost money on, where it seemed like going skiing in Killington every weekend, if you live in Manhattan, was a good idea until you did it. And then you figured out that it's 5 hours and it's cold.
Other questions? So we're just going to go around. Thomas, just pick someone. A lot of hands here.
Hi, in one of your slides, you indicated that population growth would diminish by the year 2040. Have we taken into consideration the kind of new baby boom? We have experienced a 1% birth rate increase from 20 to 21, and that's expected to double again in 22.
So we, by we here, it's the census. So you may see, well, we also have had a population decline in the last 2 years, which you saw in the figure. That would have to last a long time to overturn the forecast. Those are basically based on what are some very slow moving changes in the distribution of population. So if that pattern changes, yeah, that, the only thing I'll say is, as I said, what's remarkable is how good the census is. As someone who works in forecasting, we envy them. They actually forecast, their forecasts are usually right. There are a few forecasts we do that are similar, which is, for example, labor force participation, which is going down. And that, again, is just most of that variation over time is just demographics.
Other questions?
Hi, thank you. I'm not an economist. I'm just going to say that.
I do have a question for you. A lot of this information is really helpful when it comes to looking at folks that are out there and borrowing money. Can you talk a little bit about those cash buyers that we're seeing and how it relates perhaps to the stock market and where other assets may be more flowing that you can't necessarily put onto a graph here?
So yes, it gets into a sort of tricky area, but yes, I mean, in theory, the investors are, you know, the choice they have is whatever the second best use of the money is. That's their cost of funds, is whatever alternative use they would put the money to. And so it depends right now on what you think expected returns are, you know, in stocks and all of those things. Now, historically, and you hear this a lot right now, in periods of high inflation, returns on stocks and bonds were pretty low. And so, you know, that might be another reason why people are substituting out of stocks and bonds and into housing. And that would be another reason why we might expect people to continue paying a lot for housing. And in a way that shows up in our data, because that means that it's true that you're either choosing between buying an expensive house or not buying a house at all, if you're a purchaser. And that may also explain why it is households have responded. The response has been to just pay the higher price.
Ryan?
I'm curious too how the market is being affected by corporate buyers and out of like international money. Like, are you considering those in the purchase power of the individual?
So by corporate buyers, I guess you mean this is the
Like
single family
BlackRock,
rental.
Zillow?
Yeah. So well, not Zillow. Zillow is BlackRock is this is the single family rental asset class in commercial real estate. It's there, it's still pretty small, and it's not, for the most part, it's been fairly regional. It's been in the South and in the West, in places with high population growth. So we'll see. It's still, you know, from a macro standpoint, it's still a tiny share. It's not like, you know, I mean, the corporate investment is still mostly multifamily, and so we'll see. We'll see if it becomes, the single family rental becomes a bigger. The foreign demand, it's very difficult to judge. You know, in places like Manhattan and Boston, it probably was pretty important. As far as the rest of the country goes, I don't think. You know, and again, we've been seeing great, you know, price growth everywhere. So.
We have time for more questions here. I'm going to just jump in if I could, because I'm just dying to ask this question. Did I hear you say we have enough housing?
Yeah.
And because my understanding is from studies that have been done that, for example, New Hampshire is an estimated 20,000 units short in its inventory, and that this is an explanation for why there are long lines to buy houses, long lines to rent, why rent prices have gone up. It's just a low supply and a high demand. So just, I'm not an economist either, but I want to ask you that. Yeah.
So there are two things. One of them is that the inventory has been falling now. The inventory of homes for sale has been falling over the last, really over the last 10 years. And it's easy to misinterpret that, because you look at that and people would say, well, there are just no houses coming on the market. But actually the listing, what we call the hazard of listing, the likelihood that a property gets listed, actually hasn't changed that much. That simply reflects the fact that homes, and this was happening before the boom and before the last few years, houses stay on the time on market has been going down steadily now for 30 years. And so if you go back and you look at inventory relative to sales in 1999, and you compare that with now, this is a dramatic kind of cultural change. And so in that sense, the fact that houses sell much more quickly, I don't know whether it's the internet or, it's true that the efficiency of the market, I mean, in the sense that, you can shop, I had a colleague who was moving to Cleveland from Boston, and talk about shocking differences in prices. But she was basically, went there, and I was amazed. I mean, when I had last moved, the idea that you would go somewhere with a few properties, laid out, go choose one of them and make an offer and buy it, was something that I would never have done, when I was moving way back when. So that's one part of this. The other part of it is to come up with those forecasts. You basically have to start somewhere, and you have to start and assume that we were in some steady state at some point in the past. And so all those forecasts end up being very sensitive to what you assume when you assume we were in a steady state. And so that's why, so I heard someone on a podcast saying, well, population growth, they did the same kind of calculation I did. And then they said, and if you assume we were, 2 million units short 5 years ago, then we're still 2 million units short. And so basically it all depends on where you benchmark it. And so that's why it's hard to do these calculations. And just to say, the other thing about this that's important is that this is a macro calculation. We're basically saying, here's all the houses in America, and here are all the people in America. And actually, Cleveland is a perfect example of this. There's a lot of empty houses. There are a lot of empty homes in Ohio, but there's a lot of new construction in Columbus. And the reason is because the empty houses are in Cleveland, and people want to live in Columbus. And so you're obviously going to get some of that. People are moving to Arizona and Nevada, and during the boom they were moving to all those places. So there were empty houses somewhere, but not in the places where people wanted to live. So that is also something that is important to take into account. But it doesn't overwhelm the basic fact that the number of houses we have seems not inconsistent with the number of people.
Okay.
So in your data there, you show the expected 5-year inflation forecast. And I'm curious about where you base that data and how that compares to what we're seeing. Several reports I've seen are using numbers like 7-8%, including one of the BLS statistics I looked at for 2021 was over 7%, but your graph only goes to 3%. And I'm curious where that calculation comes from and how we benchmark that.
Okay, so there are securities you can invest in called Treasury inflation protected securities. And those securities, what they do is they index the principal to inflation. And so your interest you earn on it is in a sense real interest. And this is the yield on those securities. And so we can compare that with what you would get on a nominal security, which isn't inflation protected. And that's what the difference is. So first, to compare the number you're thinking of, this is a 5-year forecast. So this is basically assuming, so right now, you're right, we've had 7-8% inflation. That's backward looking. This is forward looking. So this is the investors who are buying these securities are assuming that the inflation rate will come down over time, and that over the next 5 years, it'll average about 3%. So that's where this data comes from. And we like it because it's a market. It wasn't done by an economist. It's done by the market. I mean, this is essentially what market participants are expecting. That's the compensation they need for inflation. But you should remember, as I said, it's a forecast. So it means what people expect over the next 5 years. And we've had 7%, going back, but that's backward looking. And so the idea is that there's still some sense that a lot of these supply disruptions are transitory, and once they get they get resolved, then inflation will come back down to historic levels, whether that happens or not.
We have a question over here.
Thank you very much. Chris Evans with Verani. Been in the real estate business for about 40 years. Seen a lot of corrections in the market. I have a lot of buyers that are saying to me, well, with the rates up, the market's gonna crash. And when does this music stop?
Well, I'm not gonna, even though I'm not speaking for the Federal Reserve, I am not going to give us, I'm not going to say the market is going to crash or that it's not going to crash. It's historically, okay, so the one thing I'll say in the past about rate increases is that this has happened. So in the 90s, in 94, there was a big rate increase. That was less than 40 years ago, so you may remember. And there was kind of a hiccup. There was a period of where house price growth slowed for a little while, and then it took off again. So the question is whether that's what's going to happen now, or I mean, we don't have a lot of instances of where rates went up and you see prices crash. The other thing about this is to remember about inflation is, you know, people who bought houses in the 70s did really, really, really well because inflation basically wiped out their debt. And so that's the other issue right now, is that historically buying homes in a period of high inflation has actually been a good thing to do. So if the reason why we're seeing rates go up is because of inflation expectations, then you might actually, that might be good for the housing market.
We have time for one or two more. Oh, we have a question online.
Yeah, we've got a couple of good questions online, but I'll go with this one first. As people seem to be paying more of their income for mortgages, does this mean the 30% rule, which affects the definition of affordable, is no longer valid?
That is a great question. So that has been in a period of high inflation, if everybody is using a 30-year fixed rate mortgage, then the real cost that you're paying is small. Most of your money is going, most of what you're paying for is in a sense real amortization of the property. And what happens in periods where when in high inflation periods is you get a lot of what we'll call innovation in mortgage markets, ways to get around the fact that basically inflation is eating away at your debt. And so even though you're making what look like big payments, basically your debt is getting wiped out. And so a lot of the innovative products that people blamed the financial crisis on, most of those emerged in the late 70s and early 80s. Interest-only mortgages, the notorious option arm. The option arm is from 1981. Those were all ways for people to get around the fact that the payment was, the nominal payment was high, but the real payment was very small. And so that is going to be potentially, if interest rates keep going up because of inflation, that becomes a big problem. And I suspect we'll end up seeing all kinds of innovation, basically to keep people under 30%, to find alternative ways to get people under 30%.
One more question online, Jason?
Sure. Do you have any suggestions for what policies could help alleviate this high cost rent situation for low and moderate income individuals and families who cannot buy as an investment and are just using their house for consumption?
It's tricky. I mean, we've been grappling with this in some ways for a while now, even before the pandemic. if people want to spend more, if everybody wants to spend more on housing, the price of housing goes up. And so the unfortunate thing is that people end up, if you look at places like San Francisco, people end up living in smaller and smaller and smaller houses. And one of the good things about the pandemic is, in our discovery that people can work from lots of different places may, in the long run, provide some sort of solution in that we don't end up with people, feeling the need to live in these densely populated places where the only solution is for them to live in smaller and smaller homes. So, but we'll see.
Okay, we're going to have to call it quits here. I want to thank Paul Willen for his observations and his time. Thank you, Paul. Appreciate you coming up and visiting us, and you're welcome to stay. We're going to have a break now, everybody, for 10 minutes. We'll see you back at your tables, and then we're going to start the roundtable discussions, and then we'll have the rest of the proceedings after. But thank you again, Paul.